My name is Michelle Loy. I'm Executive Director of the Financial Management Association International. I'm very pleased to welcome you to the seminar today. FMA is pleased to partner with the Finance, Economics, and Banking Research Network, we call them FEBRN, to host a series of virtual seminars featuring researchers at the forefront of their fields. This is the first seminar of the spring 25 semester, and speaking of a researcher who is at the forefront of their fields, we are so pleased to have Espen Eckbo here with us today. Just one housekeeping note from me. We will be collecting questions throughout the seminar, so please drop them in the Q&A module in your Zoom window throughout the seminar, and then we will go ahead and moderate the Q&A session at the end of today's seminar. With that, I'm going to go ahead and pass it on to my friend Cesario Mateus, who is going to introduce our speaker.
Thank you very much, Michelle. It's always a pleasure to start a new season in partnership with FMA that has been with us for a long time. And my particular thanks to Michelle that has been with us since the beginning. It is my great pleasure to introduce our speaker today, Professor Bjorn Espen Eckbo. Professor Eckbo is the Tuck Centennial Professor of Finance at Tuck School of Business at Dartmouth College and the founding director of the Tuck Lindenauer Center for Corporate Governance. He studies corporate finance with particular emphasis on transactions in the market for corporate control, M&As and corporate restructurings, how firms raise capital to fund investments, capital structure choices, and issues in international corporate governance. He teaches MBA electives in corporate finance and corporate takeovers at Tuck, and a PhD course on corporate finance at the Norwegian School of Economics, which a long time ago I had the great pleasure of attending as a PhD student more than 20 years ago. In 2011, Professor Eckbo was awarded an honorary doctorate from the Norwegian School of Economics. Based on citations and research impact, the data analytics service Scholar's GPS recently ranked Professor Eckbo among the top 15 researchers in the world contributing to the broad area of corporate finance. He is the founding co-editor of the Review of Finance and associate editor of the Journal of Corporate Finance. He has published it extensively in the Journal of Finance, Journal of Financial Economics, GFQA, Management Science, among others. Without further ado, Professor Eckbo, on behalf of FEBRN and FMA International and our participants and attendees today in the seminar, thank you very much once again for accepting our invitation, and we are looking forward to your presentation.
Thank you, Cesario, for that introduction and for inviting me to the seminar. Now, I decided to talk about some preliminary research findings produced jointly with Karin Torbjørn and Tana Kormakaev, as you can see here. And I did that because I've been working on this kind of issue for years in terms of the information asymmetry that arises when a buyer tries to pay for a target shares with its own shares. Going back to Akerlof, you know, it's almost like buying a lemon, a used car, and you pay with another lemon. So both sides have an issue in trying to figure out what exactly is the value that you're getting. And you might say that the price and efficiency effects of this two-sided information asymmetry situation, where until the early 2000s, the exclusive domain of rational equilibrium models, then in 2003, Schleifer and Vizhny offered the alternative of a behavioral outcome where the target ends up accepting in their model knowingly overpriced bidder shares. So I would say that our main contribution in this paper, which is in process, is preliminary. The main contribution is to condition this analysis on which party initiates the takeover. A decision that we argue strengthens the power to test rational versus behavioral arguments for the payment method choice that you see in takeovers. So now just as a definition, what is bidder opportunism? If a bidder believes its shares are overvalued by the target, it has an incentive, we would say, to opportunistically use its shares as acquisition currency. And the question the empirical analysis is trying to figure out is whether they succeed in actually selling these overpriced shares, or whether somehow the target reverse engineers the situation enough to receive a fair price in the end. Now, why should we worry about these things? Well, as we noted in the JFE 2018 paper, the larger concern is that the most overvalued, not the most efficient buyer could be winning the target, which will potentially distort the disciplinary role of the takeover market. Now, Lee Taylor Wang also made the comment on and the estimation that in a large externality, if the bidder pays with overpriced shares, you put up the price and you force other maybe more efficient buyers to pay a higher price for that target. So you essentially redistributes the merger gains across acquirers also if this opportunism succeeds. Now, I'm going back when I talk about these things typically to the AOL Time Warner merger, because it seems to be a poster child for many when they cite the possibility of successful bidder opportunism. It's more of a case study. It's not a test of anything. But in January 2000, AOL Time Warner, they merged. And in March, of course, the crash came, and more than $100 billion got taken out of the value of the merged firm. And then, of course, we had some comments, one in the Fortune magazine that's being cited by others too. The merger, the quote says, was done on terms that were insane. AOL stock was ridiculously overvalued. Steve Case, the CEO of AOL, chose the moment almost to the day when his stock was most valuable and then used it as currency. It's a strong statement. And when Schleifer-Wissner came with their 2003 paper in their behavioral model, in a sense, they're saying surprisingly the same thing. The central feature of this acquisition is not technological synergies, but rather an attempt by the management of the overvalued AOL to buy the hard assets of Time Warner to avoid an even worse returns in the long run. Now, of course, these are just speculations, interesting ones. So the purpose of this paper and my earlier work in 2018 is to try to test it, actually, and to pitch this behavioral outcome against an efficient outcome. Now, following the 2003 paper by Schleifer-Wissner, there was a number of papers that actually picked up on the notion that maybe it is true that bidder succeeds. And there are prestigious authors here along the line of the JFE, JF, JFQA, that draws inferences in favor of opportunism. I would say the literature here does not yet really test against the efficiency outcome. They also use market-to-book ratios as a proxy for bidder overvaluation. And here you see a graph that we also published in the 2018 paper of the market-to-book ratios of bidder firms in the time series from 1980 here to 2017. And you see this clear peak in the year 2000. That's sort of when the AOL Time Warner merger occurred. And it may be tempting to look at this graph and say market-to-book ratios are probably important in indicating the potential for mispricing. Now, of course, the important statistic is not the market-to-book ratio of the buyer, but the ratio of the two. And when you take the ratio of the market-to-book of the buyer and the market-to-book of the seller, this is the graph in the same sample period. And you see here that it's pretty flat in terms of there's no apparent peak by the end of the year 2000. So in a sense, what seems like a high valuation for the buyer in 2000 also meant a high valuation for the target. So it's not clear to me or us, the co-authors here, that a high market-to-book ratio should favor one side of the deal in these transactions. So I published a paper in 2018 with Mark and Torben, and where we actually did a little different type of test for the overvaluation versus efficiency. Now, the efficiency argument really emphasizes that the buyer has an incentive to use shares when the buyer is concerned with adverse selection on the target side. So, in fact, the expected overpayment cost of cash is larger typically than the expected overpayment cost of using securities. So we want to get at that sort of theoretical notion by conditioning the use of stock for payment for the target on how much the target knows about the target, about the bidder value. So in a sense, we're going straight to the information asymmetry by trying to proxy exactly how much the target knows. So clearly, when the target knows a lot about the value of the buyer, it's harder to sell overpriced shares, right? So we predicted in that paper that the more the target knows about the buyer, the more you would use stock as an efficiency solution rather than trying to use overpriced shares. And in the results we got from that paper, indeed, it is a fact that the more the target seems to know about the true value of the buyer, the more the deals are using shares to pay for the target stock. So now we also have a paper by Lee, Taylor, and Wang in the JFE in that year. And they had an interesting structural model where they tried to estimate or calculate through a model, the fraction of the deals that were overvalued and the potential loss of synergy gains that were caused by it. So we're going to go through both of these two experiments one more time. And what we're going to do, we condition it on who initiates the deal. Now, having said all this, I want to make sure that everybody understands that the information asymmetry issue is not the only issue that allows buyers and sellers to converge to a similar information environment. Of course, you have disclosure rules that helps the target. You have a due diligence process whereby the target goes in and investigates the buyer. You have merger contract provisions that helps to, both sides to break the deals in case they find out something that is causing concern materially. And you also have reasoned arguments coming out of Golubev and Malenko JF paper in 2024, where bidder common values, the degree of common values among bidders is actually affecting the decision to initiate the takeover. In a sense, intuitively, when in a pure common value setting, if I initiate the transaction, I signal to the other potential buyers what I'm trying to do here, and they might actually jump on it and use that information to beat me in the auction. So I hesitate. So that stuff, I think, also comes back into our empirical work here later on. Now, I've earlier looked at some, this was a paper in RFS in 2000, where we published the time from the first to the second bid in these public tender offers. And I'm showing you this because the average time for a rival bidder to jump in response to the first is only 2 weeks. And we're not going to use it in this paper, but it may indicate that there are, at least when you see a rival occurring in the public bidding process, the common value setting may actually be quite indicative of what's going on here. So again, the basic intuition is that when the target receives shares as payment for its shares, it will participate in the ownership of the merged firm. And that fact means that the target has an incentive to condition its accept-reject decision using its own information as well, its information about its own value. So in that sense, you get a more efficient accept-reject decision by the target firm. Now, this type of argument was developed and explained in Equilibria from starting with Hansen, actually, in 1985, Fishman, I did a paper with Giamarin and Henkel, etc. And it has evolved over time to explain why paying with stock is actually a very efficient way to go in these auction settings here. I emphasize this because when people think about behavioral or opportunism outcomes, it's easy to forget that when you see buyers using the shares as payment, it could be purely for efficiency reasons, had nothing to do with behavioral. So that's why this tension between behavioralism or opportunism and equilibria that are efficient is interesting. So what we're doing then, we're adding on to this entire literature for the first time, a conditioning on who initiates. And here's a very simple way to think about it. If you think about the market price of the bidder here, PBT time T, as an estimate of the full information price of the buyer plus an error term. So the market makes an error at any point in time. Even in the efficient market, there are errors, except that the expected error term in an efficient market is 0. But at any given point in time, the bidder may actually receive some information that its shares are overpriced. And by introducing the self-selection process, by showing who initiated a takeover, it is more likely, we're saying in this paper, that the buyer who initiates the takeover will have received some of this random information that the market is overpricing it. It's more likely that happens rather than when the target initiates the takeover. I think it's a very simple argument. There's not much to really argue about there. So we're just using this fairly obvious background and conditioning information to increase the power of the tests that we're going to do below. So we have these two hypotheses. The first one, which is the main hypothesis, a bidder firm that is temporarily overpriced by the market is more likely to initiate the deal and to include bidder shares in the deal payment. The less informed is the target about the bidder's true value. So this is the bidder opportunism hypothesis that we are proposing. The efficient payment design hypothesis, the alternative we're testing against, H2. So a bidder that is fairly priced by the market is less likely to use bidder shares in the deal payment. The less informed is the target about the bidder value. So you see the more or less informed here is the underlying driver of these two hypotheses. So they are nested within the same regression framework. And neither H1 nor H2 here is using any proxies for valuation. So we don't need an asset pricing model. We don't use market to book ratios, for example, to try and differentiate between these two hypotheses. So we go straight to proxies for how much the target knows about the buyer. Now, so we're collecting initiation data. So we have a fairly large sample. And it turns out that in 33% of these almost 3,000 cases, the target initiates, okay? And you see here, there are other people initiating. For 45%, clearly the buyer did it. This is based on S4, the history of the merger that is filed with the SEC when the target receives a public offer, it has to file. So going back to reading the initial history, you see these kinds of information. The joint, 8% joint here is basically when we couldn't decide whether it was the buyer or the seller that picked up the phone first to start these negotiations or the auctions. In 12%, the yellow here, interesting, there was a rival bidder that initiated the auction but didn't win. So the winner was a rival of the initiating bidder. And in 1%, there's merger of equals, in which case you might say they both perhaps initiates the transaction. So when you sum this up, it's a surprisingly high fraction where target initiates. Almost, if you take the joint and the merger equals as also target initiations, we're talking about almost 50%. So of the cases where target starts the process. Now, the initiation data started with several papers. Actas de Bottenroll in 2010 used initiation information to estimate bidding costs in takeovers, and other papers have since that time also collected data on initiations, generally smaller samples than we have here, and they're not using it to test behavioral outcomes. But it's interesting, those papers, there's 5 of them here, also find fraction where the target initiates that are around 30-35%. So it looks like that's the fairly solid evidence in the fraction initiations. Now, if you start just giving a little bit of information on how these auctions look like after initiations. So here we have separated the bidder-initiated ones from the target-initiated ones. And here we are using the subsample of publicly traded bidders and targets, which is about 1,600 cases of the total sample of 2,900. And what is kind of interesting here, if you look at the mean columns 2 and 5, to me, what's interesting is that there aren't that much. The numbers are similar. For example, the number of bids in the auctions, and now we're counting the number of bids from the very initiation point, from the NDA signing time, all the way to the end of the final acceptance of the bid by the target shareholders. It's about 3.6, 3.5 in these 2 samples. If you think about the number of unique buyers in the end, one buyer might give more than one offer in the process. It's 1.76 for bid initiated and 1.8 for target initiated, so it's about the same number. Average bid jumps 5% and 4%. So when I saw this data, I felt that it doesn't seem to matter much for the way the auction is played out, whether the buyer initiates or the target initiates. So that might actually set up a little bit of expectation that maybe these things, the initiation itself, isn't going to determine or going to give you a result in favor of opportunism. But we'll get there. So the key here is to how you define information proxies. So how much the target knows about the buyer at the time of the auction. And we have used a set of auction or information proxies in the 2018 paper in the JFE. And we're using basically the same information proxies here, except for one, and I'll tell you. So the local deal is when the target and the buyer companies are located physically very close. So in that sense, when they're close, they probably know more directly about the buyer firm, and they use the same labor market. They hire people from the locals. So in that sense, being locally situated to each other probably helps the target in understanding more of the value of the buyer. Now, we're using the Hober-Phillips industry relatedness, so the similarity scores that Hoberg and Phillips have produced back to 1995. To indicate that higher similarity scores means that the target knows more about the true value of the buyer. They produce the same goods according to the similarity scores, and that of course will mean that they have the same type of inputs, input markets, maybe supply chains are similar, etc. So all these things help them value the buyer again. Now, the 2 last ones here, recent SEOs and recent acquisition, means that when you initiate the deal, you look back and you see the last year and a half, did the buyer undertake an SEO or a takeover? And if they did, they would have to file with the SEC proxy that reveals a ton of information about the firm. So the target have access then to that proxy information too. So all these things are intended to say, well, if you score high on these information proxies, you probably know more about the true value of the buyer. And it's harder in that case for the buyer to sell overpriced shares to you. Now, the information variables that I decided here, if you look at how they look between bidder-initiated and target-initiated takeovers, columns 2 and 5 here, the mean values are again surprisingly similar. The local deals, the similarity scores, recent SEOs, recent acquire, all of them seem to have similar values. So again, it doesn't seem to be important for these variables who initiate, and that's going to come back in the regressions. So in the 2018 paper, we did regress on these and condition on these information proxies. We didn't do in that paper the initiation decision itself. So if you look at the blue, highlighted by blue here, these are the proxies for information by the target, and they all are positively correlated with the fraction stock used in the offer. So the Tobit uses a fraction, and the multinomial Probit uses all cash as a basis. And what you see is that the probability of using shares in the transaction strongly and significantly increases with how much the target knows about the buyer. Now, I just want to make sure that you also see there are tons of deal and firm characteristics in here, but the two interesting variables down, the competition for private buyers and the cash-only sellers, we introduced in that paper because they really help drive the decision to pay with cash. Competition for private buyers means that if a public bidder is trying to pay with shares, but it gets strong competition from a private buyer, we know that private buyers don't use their shares in acquisitions. Those are illiquid, so the targets rarely want to accept those. So if you compete with as a public company, you compete with a private buyer, you're pretty much forced to use cash more than otherwise. So when you condition on that, you see here that indeed competition, when that is high, you are much less likely to use shares in the transaction. So we condition on that too. Cash-only sellers are private equity funds selling their targets, selling their portfolio firms as targets. And they too tend to only accept cash in the deal. So we condition on those things. And in the end, these information proxy variables really drive up the probability of using stock. So that goes against the behavioral opportunism story, which would predict a negative sign on these information proxies. So now we're starting to condition on who initiates the takeover, all right? And the first thing we're doing, we're just saying, well, let's just estimate the probability of all stock versus all cash here, and just condition on who initiates and no other control variables. Just do that. And the first thing we see is that the bidder-initiated takeovers are less likely to use shares than the target-initiated ones. So in that sense, right off the bat, it's kind of surprising that when the bidder initiates and therefore presumably sometimes have information that those shares are overpriced, they are less likely overall to use shares in the transaction. So that's the first result of this paper, and it contradicts opportunism, which will predict the other way around. And now, of course, we condition all these usual firm characteristics, and we are conditioning on whether the target or the buyer initiated the transaction. Here we condition on the bidder initiating. And the first columns and in the information column here, that's sort of not, then you're not conditioning on the bidder initiation, and you see again the positive and significant impact of these information proxy variables. Now, if you condition on the fact that the bidder initiates, then you see that there's no significance left, meaning that there is no difference between whether the target initiates or the buyer initiates on these information proxies. Information proxies themselves drives the choice, regardless of whether the target or the buyer initiates. So that is probably the most important result of this paper. I included on top here, just picked out the market to book ratio up there, as you can see, because that one too is such an important variable in this entire literature. You will see that typically there's a higher likelihood of using shares when the market to book ratio of the buyer is high. This goes back to Schleifer and Vision as well. But you see here that when you condition on whether the bidder initiates the auction, that significance of the market to book ratio disappears. So that's also kind of an interesting result. It means that it undermines some of the idea that the market to book ratio is a proxy for misvaluation. Now you also have conditioned on private bidder competition here, which I said was a very strong and significant factor in driving you towards paying with more cash. And that one, when you condition on bidder initiation, actually sustained the negative and significant coefficient estimate. So these things are all consistent with efficiency choices in terms of choosing stock to perhaps alleviate target adverse selection problems on the buyer side. And also that the competition from rival bidders is driving the helping you drive towards the cash decision. So that's the first part of the paper is doing this. And then the second part, we are repeating the Lee Taylor and Wang papers structural model. And they were very generous in sending us their programming actually for the structural model, which means that our results are not driven by programming differences. So we can relax and say, well, how does that model work with our data when we condition also on the initiation decisions, which they do not. Okay, so just to quickly overview the way their model work, it works like any other structural estimation, and they use simulated method of moments to estimate the unobserved parameters of the model. So you have some data and you match the moments to the unobserved parameters. And in their model, it's kind of interesting that they have a one-sided information symmetry setup as the target is known. The target value is known also to the buyer, but the bidder value is not known to the target. On the other hand, they have an equilibrium model with rational agents where there is not enough information for the target to infer the exact bidder value. They have to infer synergies, they have to infer misvaluation, they have to infer whether the bidder has a cash constraint, so it pays with stock just because of a cash constraint, not because of a misvaluation. So those three uncertainties the target have to assess, and it can do so partially in equilibrium. So in some cases, the target will unknowingly accept overpriced bidder shares because it didn't quite figure out what was going on. So their model produces some inefficient takeovers, and the idea is to use the model and the data to see what fraction of the total number of takeovers in the sample would be mispriced that way, and also what's the size of that mispricing in terms of lost synergy gains. So we're doing exactly the same experiment using our data, which is a bit about the same sample size as theirs, and also conditioning on who initiates the deal. So the first thing we did was to figure whether the observed data moments in our sample differs or are the same to their sample moments in their sample, which is earlier than our sample period. And it's pretty much the same except for the three red data points here. So The moments highlighted in red are the ones significantly different from Lee, Taylor, and Wang, but otherwise the data is pretty much similar. So I would say this table doesn't indicate any concern that our data is dramatically different from theirs in terms of the moment generating process. Okay. Now, to quantify the efficiency loss for opportunistic acquirers, we simulate a large number of M&As. An inefficient deal is a bidder with lower synergy gains wins the target. Now, the preliminary result we get is that the fraction inefficient deals is 6.4% of the total sample. Right? Using this structural modeling, we get to 6.4% of the sample that might have been inefficient. And it's interesting that this number is very close to Lee, Taylor, Wang's paper in 2018, where they report 7% in their sample. So, and then the additional insight here is that the fraction inefficient deals is similar for bid-initiated and for target-initiated transactions, which were not addressed by the earlier paper. So the fact that the inefficiency fraction is the same regardless of who initiates, again, works against the opportunism story. Now, then we go to the loss, the efficiency loss. It's defined as the losing bidder synergy gains minus the winner's lower synergy. So this is, again, coming out of the structural model. And what we find, I'll talk about the results down here, but what we find is that, again, it does not matter whether the buyer or the seller initiates. So in terms of the numbers in the column highlighted in blue here, so the percent of target size, the synergy loss in percent of the target size in our sample is 10%, okay? And it's pretty much the same in the Lee, Taylor, Wang sample, which is 9%. So around 10% of the sample, about 10% of the synergy gains to targets are lost in these transactions, perhaps due to overpriced bidder shares. Now, if you take 10% of all the deals in the sample, you're down to 0.64% loss across these deals in synergy, lost synergy value. So the inefficiency here is 0.64% of the total sample synergies. And again, in Lee, Taylor, Wang sample, they found 0.63%, almost identical numbers when it comes to the average synergy loss across all deals. So just to summarize, so in principle, the likelihood of bidder opportunism should increase when the bidder rather than the target self-selects the time to initiate the takeover. I think that's a fairly robust statement to make, and that leads to our strategy here. So we examine bidder opportunism conditional upon deal initiations, and we find in the H1, bidder opportunism is more likely when the bidder initiates and two, the target is relatively uninformed. So the two things going on, you condition on whether the buyer initiates and whether the target is relatively uninformed. That's when you will see, you should maximize the probability of seeing an opportunistic takeover. That is tested against H2 that says regardless of who initiates, non-opportunistic bidders are more likely to pay with bidder shares when the target is better informed. That's the efficiency argument. So the results are one, average deal payments has fewer shares when the bidder initiates. R2, irrespective of who initiates the deal, the fraction stock is higher for more informed targets. Again, that's consistent with these efficiency arguments we were talking about, and it's actually, I would say, it rejects the opportunism as a concern. In the model simulations, only 6.4% of the deals are inefficient if you structure the model that way, with average efficiency loss of 0.64%. And these numbers are quite similar, almost identical to Lee, Taylor, and Wang's own paper, where they where they presented this model. So our result number 3, bid initiation does not increase the fraction of inefficient deals. And our 4, bid initiation does not increase the average synergy lost from inefficient deals. So I should say that these results are all preliminary. We haven't been able to write up the paper fully yet. It will be written up the next couple of months. I just have added, for those who are interested in a survey piece of most of the literature over the last years, I've written one with Karin Torben and Andrew Malenko. We just put it on the SSRN, and you will see some discussion there of how the literature has evolved up to today. So I appreciate that, and thank you very much for your attention.
Thank you very much, Professor Eckbo, and we are looking forward for the written version of the paper that you present some preliminary results, and that will be able to include in SSRN in our series, the FEVRN Research Paper Series. To the audience, and before we start with some comments and questions that we already have on the queue, this paper is available in SSRN, so we'll circulate to all the participants the link if you want to download and access and have a further details about its contents and how it's discussed, both the theory and the evidence in terms of corporate takeovers. I will start because one of your first slides I found quite interesting about the merger of AOL and Time Warner. The statement was insane, and the CEO chose the moment almost to the day when his stock was most valuable and then use it as a currency. We know that these issues cannot be sorted out by regulation. We have already enough regulation both in the US and in Europe with the EU directive, I think from 2004. So this is more a behavioral asymmetry of information that these situations happen. But do you think that since most of the work that we have focus more in the US and Europe, that if you move to other countries where the markets might be less efficient and more asymmetry of information, we might find more evidence of this opportunism in terms of this bidder takeover, or is neglected in terms of making studies that is outside these two main regions, US and Europe? This follow-up a question from one of our participants that he asks, where is the data from? So what is the data source of the paper? Because it was not referred.
STC, and information on initiation is from the S4s filed with the SEC. Well,
Okay.
when it comes to Europe, it's an interesting question. I think many things are different in Europe. One thing that's different in my mind is the concentration on ownership of firms. I think when a buyer and a seller sits down and the ownership of those two firms are also highly concentrated, you're less likely, in my mind, to have a situation where one party fools the other one. So I haven't done this test, of course, on the European data, but I wouldn't think that the European situation would necessarily increase the likelihood of opportunism. Now, so this again, keep in mind that this is a negotiation between two parties. It's not a stock market. The stock market itself, the pricing of the stock market itself, might trigger an initiation by the buyer. Now, and the question is whether that initial mispricing survives the negotiation process that follows. And if you are in the European setting with highly concentrated ownership of many large firms, even publicly traded firms, in my mind, I don't think that that's going to increase the chance of opportunism surviving.
Okay, thank you. But this follow-up in terms of our another participant that refers to the M&A waves, in the sense that he or she claims that market conditions might affect the choice, so not just be this negotiation between the the bidder and the target, but market conditions may affect the choice between cash and shares. For example, as it is written, more shares tend to be exchanged during bull periods and in times when is high, since the cash buyers may need to raise debt for the cash transaction. So the question that is asked is, as when is there is high, some typos here, there are more takeovers offer shares exchange. Do you control for these conditions in your paper?
Yes.
So basically the question is to say, does measure waves and
Yes.
all these conditions, if they are controlled in your paper?
Yes, it's, and I would refer back to the JFE 2018 paper with Tanakorn and Torburn, where we show exactly that. We are conditioning on the merger wave and the on the wave, off the wave type of situation when the merger occurs. Now I have this in back of my mind, this notion that, of course, we know that security issuances, debt, equity, and takeovers are positively correlated with the market's waves in the market, valuation of the market itself. And of course, when the market is high, it's partly high because of the risk factors have lower expected return. So the NPVs are higher. When NPVs are higher, firms have more investment projects that they can do with a positive NPV, and they need cash to do it. So they start raising external capital in part. They start to find more targets in part. So the fact that waves are correlated with the underlying market valuation is not surprising to me, and it doesn't at all mean anything about mispricing or behavioralism for that reason.
Thank you. There is a question from Ahmad that he raised the situation that the fact that ownership by institutional investors has been raised in the US, as all of us we know about that. Does it imply that your results could be driven more by recent deals, the last 10 years of your data, doing this substantial increase of ownership by institutional investors, or don't you think that is relevant for this matter?
No, I think that's an interesting question. I think actually we should take that up and just do it because it's likely to pop up later also. But again, the negotiations here are between two management teams, right? So it would have to be a link then back to the pension fund, for example, as an owner of one of maybe the target firm. Is it the case that the sophisticated pension fund, or the Norwegian oil fund for that matter, has opinions about this takeover? Is that going to affect the target management's opinion of the value of that takeover? That's an interesting question by itself. And but at least we can condition and see split the sample period in two.
Yeah. Thank you very much. Another question from Nima Vafai, and basically is, why should an overvalued company use its stock to bid for an acquisition? There are less risky ways to capitalize on its overvaluation, such as selling shares in the market.
Yes, no, that's a good point. I should clarify that. We don't think that overvaluation is driving the takeover decision. What's driving the takeover decision is synergy gains. If you think about the no trade theorem in economics, there has to be an expected gain from trade for both parties for any trade to take place. So we are saying, at least in my mind, we're saying that the buyer identifies the targets with synergistic gains, and then the question is, how do I pay for it? And you top it up by maybe a little bit overpriced bidder shares.
Okay. Yeah. Thank you. Dimitris Petemezas ask. First, he said that the bidder in your sample can also be a private firm. Yes. This affects, one, the information the target has for the bidder, and second, the decision of the bidder to use stock. Private equity bidders will use cash for the deal, so it will make sense to control for the status of the bidder, either the bidder is a public or private firm. Have you done that, or it makes sense to do it? That's basically the question.
Yes, and that's a good point. So we agree that a private bidder will tend to use cash. Now, it's not 100% the case, but it tends to use cash. All the results I presented today are between public buyers and public targets, so public to public takeovers. So, so in that sense, we have already controlled for that fact. Okay, so down here, for example, in this table, that's just between public buyers and public targets. So the main results absolutely has to condition on the buyer also being public.
Thank you. Thank you. Katrina Oland, she asked, what fraction of bidder, if you have that in the top of your head, what fraction of the bidder initiate deal are also deals where the target knows more about the bidder? Which is a tricky question. Given the proxies, it seems like it will be a very or be a large fraction.
So I can't give you that number off the top of my head, but
yeah,
what's
course.
important here is whether they differ across target initiated and bidder initiated. That it's a difference that is important here, right? So this table might tell you a little bit about that, right? So when you say, for example, the HP industry relatedness, the similarity scores is 0.02 in both samples. So it doesn't seem like that whatever information proxy you use here, that there is a difference as to when the buyer initiates or the target initiates. But again, it's something that we should probably talk about in the paper, is looking into the buyer itself and see how often do you see the target knowing more or less about that bidder. Yeah.
That is another question. I believe that is one participant from India, because it refers specific to India, even though it's anonymous. And this relates somehow with my first question, but you can elaborate on it. How do you see the findings of your study as implications for the emerging markets such as India, where bidder seems to exhibit opportunistic behavior? We hardly get to see the targets initiates the discussion. Basically.
Yeah, so when I think about other countries, I think about the whole takeover process. How structured is it? How much information does the regulations require you to inform target shareholders? You know, in the US, you have these Williams Acts that are really making takeovers into public auctions in a structural way. So in a country with weak corporate governance structures, there can be more opportunism for sure going on, simply because the target doesn't get information about the buyer. So I would say from a regulatory point of view, it's important to create these structured informative auction settings, which is a government policy kind of thing, in order to avoid opportunism, by the way, on both sides. I mean, this is two-sided information asymmetry. A target might walk up to you and try to sell itself being highly overpriced. Now, in the US, that's not going to happen much, I think, because there's so much information about the target that the degree of information asymmetry on the targets between buyers and sellers on the target side, I think is not alarming. I mean, it still exists, but not alarming. And we know, for example, from an early paper by Masoulis and Simsir, that the target that initiates tend to get lower premiums out of these deals, partly because they're actually not doing so well. A decision by the target management or target board to sell itself, to me, is a dramatic decision, right? And you won't do it easily. You can't go to, there is no investment bank that can call up another firm and say, you should sell yourself, right? This comes initially from the board of the target. And why do they think this way? Well, probably because then they may be sliding toward bankruptcy, or then they need cash or something like that. And this is clearly obvious in the disclosure rules of the US, so the buyer would know these things. And indeed, you tend to get lower premiums for that reason, weaker bargaining position.
Thank you very much. I promise that we finish on time because you have commitments just right after the seminar. There is only one additional question, if you allow me,
Yep.
just
Go ahead.
from Vidur Sagal, and this is the last one, I promise. The monies exchanged in the mergers or acquisition are normally more than 3 times the physical installed capacity that exists before the M&A of the subject takeover entity. The question is that if you observed this in your research, or if was some extent confirmed on it, if you look to it as well or not. So that's the question.
You have to say that again, actually. I didn't quite get it.
They say that the exchange during the mergers and acquisition goes much above what is the physical installed capacity. That's how our principal define it. That exists before the M&A. So basically 3 times more of the subject takeover entity. If you have some values about this as well.
Are you talking about, is it the premium we're talking about?
Yes, I think so. It's about the premium.
Yeah, so the average offer premium is about 40%.
Okay.
And based on an estimate of the standalone value of the target going 2 to 3 months before the first bid. So yeah, so you now the 40%, of course, is the target share of the synergy pie, right? So if the pie is big, the 40% is a huge dollar number. If the pie is small, the 40% is a small dollar number. So typically people debate these premiums just in percentage terms, but it's
not in the multiplier.
Yeah.
So, okay. Thank you.
Yeah.
And thank you very much. It was so great to have you with us. We have to postpone once for multiple reasons, but it was a great pleasure to have you with us and to discuss a so important topic and so actual still. And basically, we are looking forward as well to your written version of your paper, so we can, through FMA and FEVERN, disseminate to all our followers that want to be up to date and in the state of art in all the research in finance, economics, and banking.
I appreciate that, Cesario. Thank you very much.
Thank you. Michelle, you want to say some final words?
Just echoing my thanks. I did drop a link to the related SSRN paper in the chat as part of the FEB-RN series. Thank you so much, Espen, for your excellent seminar today. Please join us here on March 6th for our next seminar with Rina Agarwal.
Will do. Thank you, Michelle, too.
Thank you.
Have a good day.
Professor. Thank you.